Hello, everyone. Somehow we have managed to make it to the fourth quarter of 2021, and it's time for our fourth quarter market update. It's been a very interesting and exciting year so far, to say the least. The markets have for the most part, been fairly tame this year. We haven't seen a whole lot of volatility, and that's a good thing in many ways. So I'm going to talk a little bit about the economy, and then I'm going to turn things over to Mike to get into some more detail with you on some of the other aspects of what's driving our investment decisions right now for everyone. So, we've got inflation. So inflation has really heated up a lot. We've got a lot of really strong consumer demand. And we've got that coupled with supply shortages across many of the major sectors in the economy: food, energy, et cetera. I'm sure you've recognized these price increases when you've gone to the gas pump or the grocery store, for that matter. No one's escaping this. The consumer price index has been tracking above 5% year over year since the start of the summer. And you couple that with the global semiconductor shortage, we've seen a real increase across a wide range of goods throughout the economy, most notably automobiles too. So big impact on the inflation side. And I didn't even mention the fact there's been a lot of money printed as well. The U.S. economy now is on very solid footing, though, in many ways because of our progress coming out of the pandemic at home and abroad. It's a nice tailwind for the global economic recovery. U.S. consumers now enjoy their highest net worth on record. So obviously, a lot of the money that people receive went to reducing debt during the pandemic. Corporate earnings have been surprising to the upside. For the fourth quarter in a row, we've seen surprises to the upside. Really big corporate profits that we've seen out there. And we're expected to see them to grow in 2022, but corporations will have to deal with rising input and labor costs. So their commodities that come in and their labor costs are going to go up. And again, that's going to be inflationary. Regulatory actions intended to contain leverage and property speculation have really dragged on the Chinese economic growth. And we view China's deceleration as one of the greatest risks right now to the global economy and global growth. We are watching China very carefully and not investing there. We can help it. Since the beginning of the pandemic, the Federal Reserve has provided significant monetary stimulus. And I'm talking about the Reserve now, not the federal government. They cut the federal funds rates to near zero levels and have been adding substantially to their balance sheet with $120 billion of bond purchases each month. At its September meeting, the Federal Open Markets Committee delivered a slightly hawkish message that while the Delta variant has slowed economic progress a little bit, the labor market recovery has been robust, and inflation may be somewhat stickier than they previously thought. I think many of you know we've been talking about inflation being a lot stickier than what a lot of the pundits have been saying. They also gave the first official signal that tapering its bond purchases could soon be warranted. They have meetings in November and December, and we do think at one of those meetings they may announce that they will begin tapering their bond purchases. And keep in mind that this massive injection of liquidity by the Fed by buying bonds has helped sustain a very low interest rate environment despite the rising inflation. So that's one of the reasons interest rates haven't gone up, is because of this bond buying. If they start to taper, that could impact interest rates. Year to date, investment grade corporate bonds are actually off 1.6%. They rallied recently, but they're still off significantly for the year. Long dated U.S. Treasuries are off as much as over 4%. And one of the few relative bright spots in the fixed income space has been municipal bonds, which are actually up 0.8% for the year. Interest rates are generally expected to move higher over the next few years, which would continue to serve as a headwind for the fixed income space, particularly for long dated bonds. Keeping in mind that every 1% rise in interest rates usually results in an 8% drop in bond values. At the same time, fixed income remains an important asset class, as bonds are going to provide diversification and serve as a ballast, so to speak, for your investment portfolios during times of market stress. So we need to keep fixed income in place. And we are focusing now more on shorter duration bonds going forward to limit the interest rate risk that is out there. As far as the stock market is concerned, we did have a sell-off of about 4.6% in the S&P 500 to finish the quarter in September. You probably knew that, but it did actually finish up for the quarter, 4308 by about 0.58%. And the forward price to earnings multiple is now 20.3 times, which is more than one standard deviation above the long-term average of 15.5 times. And the NASDAQ Composite and the Dow Jones both experienced a negative move in the third quarter off of some of their previous highs. So the NASDAQ and the Dow were hit a little bit harder than the S&P in that September sell-off. Higher inflation, soaring energy prices, wage pressures, and a possible hike in the corporate tax rates could put a damper on valuations in the years to come. However, the valuations may be justified, might be, if corporations are able to continue to beat earnings expectations like they have been. It will be crucial to keep a close eye on profits and valuations when positioning equity in the portfolios after this pandemic is finally over. The valuation gap between the most and least favored stocks is well above the 25-year average that we've seen. So while the overall market does seem fully valued, we see a lot of areas of opportunity to pick up companies that have really strong balance sheets at attractive valuations. Financials, industrials, healthcare are among the sectors that we are most excited about. We remain underweight international equities, but we are beginning to gravitate towards value stocks in developed international markets, something that does have some appeal. The remarkable run-up in equities seen an unusual lack of volatility, which I mentioned earlier. Small sell-offs have been treated as buying opportunities. It doesn't seem as if we can drop more than 5% without it being seen as a buying opportunity and people jumping back into the market. But we would remind everyone that corrections of 10% or more are normal. Normal. 10% drops in the S&P 500, the Dow, or the NASDAQ are normal and occur more frequently in the middle of a business cycle. So we are looking for one to occur, and don't be surprised if it does. We do not expect to see the outside gains that we have enjoyed over the last few years in equities. But equities do remain an excellent hedge against rising inflation, so we need to remain invested. While we have our concerns about potential valuation compression in the equity space, we continue to believe that equities still offer that primary opportunity over the long run to generate wealth for everyone. So those are some of the things that we are thinking about right now on a high level. And we really do feel like that you've got to stay invested in equities to stave off inflation. You've got to beat inflation. One of our goals is to always beat inflation by about 2% or more, no matter what we're looking at out there. Because if we don't stay ahead of inflation, you're losing money. And so we've got to do that. So I'm going to let Mike talk a little bit more about what we're doing, but just suffice it to say that equities, real estate, and also commodities are three areas that provide the best inflation hedges out there. So Mike, I'm going to turn things over to you and let you go through some of the charts.
Thanks, David. I'm going to start off by looking back at the S&P through the years, and you can see the remarkable run we've made. We made lows back in March of 2020, and it's been an incredible ride since that time. The bull market did take a bit of a pause in the third quarter with major indexes off slightly. The S&P was able to generate a slight return despite the 4 to 5% sell-off we saw in September. But it did take a pause here. So we ended the quarter with a price to earnings multiple, the forward multiple of 20.3 times. Forward price to earnings multiple is a popular way to measure market valuations, and we just take the price of the S&P 500 and we divide it by the expected earnings over the next 12 months. So 20.3 times right now. We did finish, that multiple has come down from the end of the second quarter, where it was 21.5 times. And we would expect to see further compression of the multiple as corporate earnings continue to impress. And there'll be some other factors that'll bring the multiple down a bit, as David mentioned. Wage pressures, higher inflation, energy prices. So we could see a further compression there. But it's important to note that while the multiple is high right now, we still want to stay invested, as David mentioned, and keep pace with inflation. This is the forward PE multiple chart at 20.3 times. Has come down, but while it's come down, it's important to note it's still above one standard deviation over the historical average of 16.7 times. So we'll want to pay close attention to valuations as we go forward and use profits as our guide when we're positioning stock portfolios for the post-pandemic environment. And if you look at just about any valuation measure right now, it is higher than the average, whether it's price to book, price to cash flow. It is elevated, and partially because outright interest rates remain extremely low. So money has fled out of the fixed income markets into equities and have increased the valuations there. Corporate profits have hit a record high this year. And one of the amazing things to look at, if you look at this brown bar, those are the margins this year have been phenomenal as companies have really dealt well with the post-pandemic, with technology during the crisis. They've come through this quite nicely. We've seen very little impact to healthcare, consumer staples, technology, communication services. They saw a few negative impacts, and in some cases, they saw stronger revenues. We're seeing strong consumer demand and higher productivities as businesses have reduced costs and they come into a more virtual environment. And there's a lot of talk next year about companies will be able to increase the buybacks, share buybacks of their shares, which tend to be a nice floor for the market. And it's important to note too that every single sector in the S&P has seen increased margins this year. Going forward, it will get a little higher as we head towards slower growth, higher wages, higher interest rates, and a possible corporate tax increase. The environment won't be quite so perfect for corporations to roll in, but it's still a good setup for stocks going forward. And looking at value versus growth stocks right now, after years of strong outperformance of growth, particularly during the pandemic, value had a really strong start to this year. And if you're wondering if value still has room to run, look at the slide on the left. Value still appears to be cheap compared to growth at the moment. Value tends to outperform during periods of above average economic activity, which we are anticipating. Right now, it's also important to look at the right, see which companies are most correlated to GDP, and the highest correlation is industrials, and the lowest correlation is utilities. Goldman Sachs, their analysts are expecting GDP to grow 4.4% in 2022. So we'll want to have exposure to industrials, certainly, as they'll tend to benefit from an improving economy. Looking at the international markets right now, valuations remain attractive in both developed and emerging markets right now. And earnings growth certainly looks good in Europe, in emerging markets. We have chosen to not directly invest in China. emerging markets are more risky than developed markets. And the recent actions of the Chinese Communist Party have given us pause. It's really difficult right now to invest with any confidence with the interference they're introducing to their industries over there. We want to avoid China. There's a lot of other good opportunities elsewhere. We're still overweight in the United States, but we are seeing opportunities emerge in Europe. Europe has good growth projected for next year, and their stocks are trading at a pretty nice discount right now. So it's something we're taking a hard look at. You probably all noticed at the pump the incredible rise in gas prices just over the last year. We've seen strong demand come back in oil markets, and production is not keeping up. You can see the rig count and inventories chart on the left. And going back to April 2020, crude hit $11.50. And you can see it closed the quarter at $75, and today it's trading somewhere around $83 a barrel. Oil, some analysts are calling for it to hit over $100 a barrel in the near term. So, important thing to watch. Oil is obviously crucial to our economy, and it is a major input for just about every good we purchase. We're keeping a close eye on that. It's a major contributor, obviously, to the inflation we're experiencing today. Looking at the real yield right now, this real yield is the lowest we've seen in years. That's the brown bar, the -2.5 figure. We find real yield by looking at the yield of the 10-year Treasury, which is currently around 1.5%, subtracting inflation out, and inflation in this chart is 4%, even though it's probably higher. So we are getting a real yield right now, -2.5%, lowest in years. And this is important because, as David said, you have to keep up with inflation. So if you are parked in very safe investments like treasuries, money markets, and CDs, you're falling behind inflation, you're losing purchasing power. Taking a look at the bond markets this year, a lot of red on the left-hand slide. The worst performer this year has been the 30-year U.S. Treasury, off almost 9%. Investment grade bonds off over 1%. High yield bonds are positive 4.5%. They have a high correlation to stocks, which have been strong this year. And munis have been okay. Munis are positive 0.79 this year. Look at the right, though, and we were talking about the anticipated increase in interest rates that we see in the next 12 to 18 months. Look what just a 1% increase rise in interest rates will do to the total return of bonds. And the hardest hit are long-dated bonds, and this is the 30-year U.S. Treasury that could be really impacted here if we get that 1% increase. Investment-grade bonds, you can see a total return of -6.5. So bonds are, we don't see much appreciation going forward. It's going to be a challenging environment. Yields are very low, and anticipated appreciation is just not there, even though we do need some in the portfolios for diversification, safety. Not a lot of excitement at the moment in fixed income. We've had an unusual year with strong market returns and very little volatility. Year to date, we've only had that 5% dip back in September. And as David was saying, it's common to see a 10 to 20% correction just about every year. And we don't try to manage around corrections. We identify stocks and funds that we want to hold for the long term to hit your objectives. And it's important to note, even with these sometimes drastic sell-offs during the year, the average in-a-year sell-off is about 14%. Markets have still been positive 31 out of the past 41 years. So gives you a nice perspective here to stay invested, even when sometimes it may not feel good. And the last slide I'd like to share with you today is the valuation dispersion. We're seeing the widest gap in years in the least and most loved stocks in the market right now. So this really tells me there's a lot of opportunity to pick up some really decent stocks right now with good balance sheets that are just underloved right now by investors. And we may want to avoid some areas that have really have gotten just too pricey for us. And we have some funds that we're using to help us identify and do a nice screen for us where we can make sure we're picking up companies that don't have excessive debt and we're not overpaying for these stocks, certainly. So the U.S. economy is on solid footing as we close out the year. And even if the Fed begins to withhold liquidity, we're seeing further progress on the pandemic worldwide, and that'll be a tailwind for the global recovery. And political headwinds, there could be some near-term volatility with politics as always, but they don't represent major roadblocks at this time in our view. But given the impressive appreciation we've seen in markets over the last few years, it would be wise to focus on fundamentals and valuations and maintain a diversified stance as we enter 2022. So I'm going to bounce it back to David, and feel free to email in any questions. We'd be happy to hang in here and answer any questions you have.
I really do, again, appreciate everyone. We appreciate you guys a great deal. I was talking to somebody this week, and I said, it's really nice to come to work and know you get to see and meet with people that you really like and enjoy spending time with. And I can say that about all of our clients. So I really do appreciate your trust and your confidence in working with us. And we hope to be able to continue to earn that trust each and every day. So we will see how prices behave here going forward. And they will, they've been rocketing up, and they are probably going to parachute down very slowly. And again, that just has to do with getting supply chains fixed. So again, appreciate it from everyone. And we'll be seeing each of you soon in our next meeting. So from us here at RVA Wealth Management, thanks, and we will see you soon.